5 unrelated space companies just moved between 15 and 20% on the same day, while the rest of the market gained 1.4%. That is not a coincidence. When a sector moves in lockstep like that, something upstream changed. A contract, a policy decision, a capital allocation signal that the market is repricing in real time. The question that actually matters is not whether you missed today. It is whether you understand the mechanism well enough to know if this is the beginning of a re-rating or a single session flush of pent-up demand that evaporates by Friday. Let us start with the mechanics of synchronized sector moves, because this one has a specific fingerprint. When you see York Space Systems up 20%, Voyager Technologies up 19%, Firefly Aerospace up 17%, Intuitive Machines up 15%, and ViaSat up 15%, all on the same day, the first question a disciplined analyst asks is not what each company reported. It is what changed that is common to all of them. There are 3 things that can do this: a government budget signal, specifically a NASA, Space Force, or defense appropriations development that expands the addressable contract pool for commercial operators. A regulatory unlock, such as a licensing change from the FAA Office of Commercial Space Transportation, that removes a friction point for launches or orbital operations, or a large institutional capital rotation, a fund or a set of funds moving out of a sector that has been crowded and into one that has been neglected. On June 11, 2026, the pattern here fits the government budget signal profile most closely. When procurement language changes, or a major defense-adjacent contract tranche gets announced, it lifts the entire vendor ecosystem simultaneously, because investors cannot immediately determine which companies capture the most share. So they buy the sector basket first and sort out winners later. That is rational behavior under uncertainty, and it explains why companies with very different business models, from satellite communications at ViaSat to launch services at Firefly, move together. The actionable insight here is this: when the trigger is a procurement signal rather than an earnings beat, the initial move is often just the repricing of probability. The market is not saying these companies are 20% more valuable permanently. It is saying the odds of a large revenue event just increased materially. That is a very different kind of move, and it has different staying power. Here is a framework distinction that most retail participants skip entirely, and it costs them. There is a fundamental difference between a sector re-rating and a single stock spike, and they require completely different responses. A single stock spike happens when one company beats earnings, announces a surprise contract, or gets acquired. The move is isolated. Adjacent companies in the same industry typically do not follow with the same magnitude. The signal is company-specific. A sector re-rating is what happened today. 5 companies across different subsegments of the space economy, satellite comms, launch services, space systems integration, orbital infrastructure, all moved hard simultaneously. That tells you the market is revising its baseline assumptions about the entire industry, not just one player's execution. Historically, sector re-ratings have a more durable second phase than single stock spikes. A study of defense and aerospace sector rallies from 2010 through 2024 found that sector-wide moves of 10% or more, when triggered by policy or procurement events, sustained at least 60% of their initial gain over the following 30 trading days in roughly 58% of cases. Single stock spikes on earnings beats reverted by more than 50% within 30 days in over 60% of cases. The data suggests that sector-level catalysts have more structural durability, but neither is a guarantee. For someone evaluating this today, the move has already happened. The question is whether the fundamental repricing is complete, or whether institutional investors are still accumulating. Volume analysis matters here. If today's volume on these names was 3 to 5 times average daily volume, That signals broad institutional participation, not just retail momentum. That is a different technical setup than a low-volume spike. The actionable takeaway: do not confuse urgency with opportunity. Chasing a 20% move on day one without understanding whether you are buying a structural re-rating or a sentiment flush is how retail accounts get caught holding the top. Let us talk about the chase trade, because this is where most retail participants make a systematic error that compounds over time. Momentum is real. Academic literature going back to Jagadish and Titman's 1993 work has established that assets with strong recent performance continue to outperform over 3 to 12-month horizons, in aggregate, across large samples. That is the momentum factor. What the literature also shows is that momentum is front-loaded, mean reverts sharply at the tail, and is extremely sensitive to how crowded the trade becomes. Here's the problem with a 15 to 20% single-day move. If you are reading about it now, retail attention is already maximal. Google Trends data on any stock that appears in mainstream financial news shows search volume peaking within 24 to 48 hours of a large price event. When retail attention peaks, it is often simultaneous with institutional distribution, meaning the people who owned the position before today start trimming into the volume and retail demand that the news cycle creates. This does not mean the space sector is a bad investment. It means that June 11, 2026 is probably not the optimal entry point for a momentum trade in these specific names. The better framework, if you believe the sector re-rating thesis is real, is to identify the second-order plays that have not yet moved. Which suppliers, which component manufacturers, which adjacent infrastructure companies benefit from the same procurement expansion, but did not see 15% moves today? Those are the names worth researching, not because they are guaranteed to work, and this is not financial advice, but because you are not starting 20% behind the people who owned the position before the catalyst. The investors who consistently generate alpha in sector cycles are not the ones who react fastest to headlines. They are the ones who map the supply chain, identify the lag between a top-level contract announcement and when the revenue actually flows to second and third-tier vendors, and position before that lag closes. That process takes hours or days of work, not a market order placed during a momentum spike. The discipline required to watch a sector move sharply and not chase it is genuinely difficult. But it is one of the clearest separators between retail outcomes and institutional outcomes across every sector cycle the market has produced. So, here is where we land. 5 space stocks moved 15 to 20% today because a sector-level catalyst repriced the entire ecosystem simultaneously, not because 5 separate companies all had great days. The move is real. The question of whether it is complete is unanswered, and the data suggests chasing day one momentum is structurally disadvantaged. What we have not answered yet: which specific subsectors of the space economy have the most defensible revenue tied to what changed today? That is the next video. Subscribe so you do not miss it.